Stop losses. They're often regarded as the go-to solution for managing risk and trades. But are they really the only option we have? Many traders rely on stop losses as their primary defense in trading. What if I told you there's another approach to risk or money management that doesn't involve immediately taking a loss? In this video, I'll be introducing a different approach: hedging. It's a strategy that gives you the flexibility to manage your trades in a more dynamic and market-directed or informed manner. It's the approach I'll be focusing on today and likely the one my trading will be actively using in the near and far future. Stop losses are a tried and tested method in trading. They work well for protecting your account from significant drawdowns. By automatically closing a position when it reaches a certain price, stop losses help manage risk. Sadly, stop losses aren't foolproof. At times, you might get filled at a different price due to the market volatility or might be wicked out by sharp temporary price movements before the market actually turns in your favor. This isn't a jab at stop losses. They are effective. However, its limitations have driven me to explore a different approach. In hedging, instead of using a stop loss to exit a trade, you place an opposing trade to offset the potential losses from the original position. When you use this approach, you're hedging your bets, allowing room for the market to move while managing the risks without immediately closing out losing positions. It's a more dynamic approach to managing trades. As a result, it gives you the time to adjust rather than locking in losses instantly. You might ask yourself, if it's dynamic and you end up with more open trades, how is it better than the stop loss approach? To answer this question, I'll dive into my philosophy of risk management and an example to demonstrate how hedging would work as a replacement to stop losses. Think of a situation where you have entered a trade and it goes against you. The commonly recommended approach is to take the loss and start looking for another trade. However, this doesn't augur well with me since it essentially puts a stop to your rhythm. Most traders only analyze what happened and their trades a day after. This, I think, creates a disconnect between what you were thinking of in the moment and the notion of risk management. When talking about risk management, the often recommended steps include only risking a maximum of 2% of your account and then setting a stop loss. And then it stops. Rarely do people consider going past this point. As a result, a disconnect between managing trades or losses is created. As a result, a disconnect between managing your trades and losses is created. This results in the belief that the only way to manage your losses is to take them and move on. While this is generally sound advice and works in most situations, it's not always the solution in as far as trading is concerned. At the very least, I'd say this approach served as one of the factors that discouraged me from continuing to analyze the market or come back later tomorrow. Essentially, I'd come back with the pains and angst of the previous day, and with constant losses, it discouraged me from further continuing to trade. This is why I want to move to hedging. It allows me to work myself out of losing positions and losing situations. As such, I not only look forward to the next trading day, since I can come in and reclaim my money, but it also allows me to continue to make some along the way. I understand, to some, this can be considered as a psychological crutch. However, I'd argue that if there exists a tool that would allow you to continue participating in the market while being profitable and staying within reasonable levels of risk, there shouldn't be any reason not to use it. In this regard, I intend to use hedging as an approach to managing my risks while continuing to stay within the rules of my trading strategy. I'd like to explore one example of how this might work. This is just the general gist of the money management approach, and I credit the entire idea to the YouTube channel Forex Hedging. The channel discusses a novel approach to hedging where you gradually close out a losing position using some of the profits from a winning position. This sounds simple enough, but it requires a hands-on approach to fully understand it. As such, regardless of the example I'll give, I'll still recommend watching the videos on the recommended channel, testing it out, and keeping an eye out for future videos where I'll be covering more examples of this approach. Now let's move to the example. Consider a situation where you entered a buy position with one lot. In this case, you might set the stop loss at 20 pips and expect the market to take you out at 40 pips profit. However, it does the opposite and heads straight for your stop loss. When using hedging, you do not set a stop loss. Instead, you set an opposing sell trade of equal magnitude to your buy trade. This is how that would look. Once triggered on both sales or hedged, you go into loss management mode. In this example, if the market heads to the 40 pip level of either trade, the other would have a corresponding loss of 60 pips. With one lot of risk, you'd be sitting on a profit of $400 and a loss of $600. If you decide to close both trades, you would net a $200 loss. However, using the hedging approach, you can decide to instead use $100 of the winning trade to add to your balance, and then use the remaining $300 from the winning trade to close out half of the losing trade. I got the half there using this formula. You take the profit that's remaining once you take a bit of the profits to add to your balance, and then divide that by the total loss from your losing trade. Once you get that value, you multiply that by the volume of your losing trade. In this case, this would give us $300 divided by $600, and then you multiply that by the one lot from the losing trade. This results in 0.5 lots. This number doesn't always get to half of your losing position, but this is just the first trade. Once you have closed out the half lot, you can decide where to re-enter with an opposing trade to make sure that you limit the losses from your existing losing trade. Once again, whichever trade gets to the level you had preset, let's say 40 pips, you close out part of the other one and keep some of the profit. For those keeping up with the math, you might have noticed that this results in your balance increasing, and for a time, your equity decreases. However, this does not last forever, since you keep reducing the risk and/or the market inevitably reverses, which is a given the very nature of forex markets. Ultimately, you end up closing out your losing trade fully while making some money on the side. There are demerits to this approach. One example is the significant drawdown on equity associated with the approach. You also earn less overall on trades that are hedged compared to trades that do not end up being hedged. However, I consider this the cost of doing business. Furthermore, I notice this approach is friendly on my psychology, as it does not create the disconnect with money or risk management. Of course, this video does not go in depth about the approach, but I intend to soon upload a backtesting video that will explore more examples. As you wait for that video, I'd definitely recommend watching some videos from the Forex Hedging channel. In the future, I'll also be exploring other strategies such as break and retest, ICT, supply and demand, trend lines, indicator-based strategies, and many others, and how one can use hedging to work their way out of losing positions from these strategies. In summary, I intend to integrate hedging in my trading and will be including it in future videos. I do understand that hedging is not for everyone, and some actually harbor negative views about hedging. Regardless, I'd recommend backtesting the approach and making sure you fully understand it before using it in live markets. Additionally, backtesting it and testing it for yourself is the only surefire way to know whether hedging is for you. Don't forget to like, subscribe, and share the video. Until next time, keep trading, keep working on yourselves, and remember, stay consistent.